thank you everybody for being here. I hope I bring some value to your time here talking about student loans. I know there is a lot of a nightmare out there. Hopefully, we can clarify some of those questions. Alrighty, so Jonathan already spoke a little bit about what I have done. My path was reached, or actually I continue the path. I think that we don't stop the path until we die. But it's thanks to student loans that I got my education in that now I am able to provide service for my clients and for my community. So I appreciate that I had that opportunity, and I was able to navigate the student loan path. All right, so remember, this is for informational purposes only. So please don't take it as advice. Everybody has a specific situation, and as we will see a few cases in the presentation, that depends on what goals you have and what situation you are in. All right, so we know there are some ways that you can start saving for education. Of course, it requires that you start earlier, preferably, so you can have more time for the money to grow and able to have those monies for education. So it could be, we have some programs even in the city where you go to you take your child to public school, and there are some funds. I believe it might be $500 that San Francisco provides to initiate the K2C. But then that could become a 529, and then you can continue putting money into your children's education savings. Also could be custodial accounts, covered the ESA 529. So I'm just mentioning some things that you might know. I'm not going to go deep into that. I'm just sharing what vehicles you can use to get to the monies for your child or for yourself. Another non-very conventional at the bottom here, we see the Roth IRAs, taxable investments accounts, and life insurance and annuities. And I'm bringing that life insurance and annuities. It's not common anymore, but before 529s, a lot of people used to use that. Not the best place to go. So please don't take that as like, oh, I'm going to check into my life insurance, because it could be very expensive to have a life insurance and not worth the cost when you can have 529s, for instance, for savings. So here's just some vehicles if you decide or you are able to save before sending your children or yourself to college. And as we see in this slide, could be better if you could plan and if you have the funds to have the savings throughout the years. It's a smaller amount that you can put away, so you can have those savings for college. But if you're not able to do so, or for some situation, it just got late in life for you to be having that plan, then you might have that student loan, right? And at the end, you get to where you want to go, but it could be advisable to start planning earlier. But of course, we're going to talk today about this side of what happens if you didn't, for some situation, save, but you want to get money or you got money to go to college as a loan. So as we know, the number of people that need loans in order to get an education is really high. Over 50% of the people that get an education actually have debt in order to pursue that goal. So I'm not going to read this slide, but that's just showing that the percentage is really high. But then what happens? You graduate, and if you're lucky, you get a good counselor, and you talk about your student loans, and then voila, you get into a good repayment plan, and you are set, and you just have to manage it, right? But life changes. It could be that when you went into a repayment plan, you were fine, single, and not much of an income, but then life gets wealthier, maybe that you get married, there's now two incomes, or you just grow in your career. And now if you're in an income driven plan, now it might be more expensive to pay your loans. And then what do you do when you want to do other things with your monies? So that's why repayment plans and having a goal and pretty much speak with somebody could be very beneficial. All right, what are we going to cover? I'm going to mention what types of loans you might have on record, right? Loans have been given for many decades now, but things have changed. So we're going to go cover the types of federal loans, types of plans throughout the years, what are income-driven plans, IDR, and you will see that the acronyms look like each other and it could be very confusing. But ID, dog, R is the umbrella, is the income-driven repayment plans. For those of you that work for the city, work for the county, work for the state or federal, so some type of government, or in a nonprofit, 501c3 specifically, there is a path, the PSLF path, right? So that's a shortcut. That's a 10-year rather than going on a 20-year, 25-year path. So what strategies are we going to cover here? So there's some, other than getting into a repayment plan, there's other things that you can think of to lower your adjusted gross income or how you file your taxes. And then any updates. There have been so many updates in the last few years, and there is a lot of mysteries in the last months. So I'm gonna try to cover that and like tell you what to be worried about or not. Alrighty. So let's start with the types of federal loans. At the beginning, before 2010, we saw the Federal Family Education Loans, FFEL loans. So if you have been going to school for a while or you went to school long ago, but you still have loans, you see that you might have FFEL loans. Now, in the last couple of years, the administration was trying to get you into a consolidation of loans. So if you have those older loans, will it be beneficial to consolidate them into direct loans in order for you to gain access to newer or the most recent repayment plans, right? So it's possible that you did have FFEL loans at some point, and now you only have direct loans because if you consolidated recently, you can only consolidate into direct loans. So federal, FFEL, federal family education loans and direct loans, those are the main ones. But then, of course, Perkins loans for people with the lower incomes and able to qualify for those. Those are provided, is less common. And private loans on people that whether they don't know that they could qualify or they didn't apply on time for the federal loans, they might have gone to private loans or they just chose to go into private loans. Also, some people too exhaust the loans that they can get for their children or themselves and they go into the private loan path. I did that. I did exhaust some of my a year or two, maybe a year, and then I went into private loans. It was way more expensive with Sallie Mae for those private loans. So we have to be careful about what we're getting into. Usually, it's best to go into federal loan debt. Alrighty, so here's some types, and for under the umbrella of the direct loans, you will see subsidized and unsubsidized. What it means, this is for the undergrad side, is that some of those are going to be paid by the government. The interest is going to get paid by the government while you are still in school. The unsubsidized doesn't, right? So that is subsidized and unsubsidized. And then for the plus loans, that's for if you're going into higher education, then you have access to even higher amounts of loans. And that's where you're gonna see the plus. All right, so, and please, Jonathan, if there's any questions about this specifically, it's fine to ask now.
Yeah, no questions at this point. And it's a good opportunity to remind everyone, if you do have questions, put them in the Q&A window. And we'll either answer them in the course of the presentation or at the end during the dedicated Q&A time.
Thank you. All right, so here they are for the repayment plans. The most common is that if you don't choose anything, they send you into a standard repayment plan. And you might say, well, okay, so all right, I don't like the standard repayment plan because it's too expensive, right? So you send me into the 10-year repayment plan for my 150,000. So that's a lot of money for per month. What else can I do? Well, there is a graduated repayment plan which changes the amount of payment every 2 years, but at the end you're going to have to pay it off like in 25 years. 20, 25 years. And then the extended repayment plan, that could go 25 to 30 years. Now, remember, the longer you're paying your loan, the more you're going to be paying in interest, right? So we have to be careful with that. And that's why maybe, depending on what you're going to do with your lives, is an income-driven plan will be better for you, right? So income-driven repayment plans, again, they might be with, if you have loans that are direct or FFEL loans, some of those income-driven plans might not let you get on that specific income-driven plan because you have FFEL loans and you might have to consolidate your loans. Again, this is for the older loans. My wild guess here is that you probably have direct loans over the FFEL. Okay, so what is the story with income-driven repayment plans? Well, they started in 1994, and that was because they decided, well, okay, so how can we help the communities if the standard repayment plan might be too high for some people, depending on what choices they have in life, right? So people might choose to go in a nonprofit world, or they might choose to be, in service, public service, and the payment is not as competitive as going to the private sector. So they say, okay, so why don't we do this where the payments are based on your income rather than on your balance, right? So the, the balance, one example is a car. You buy a car and then they tell you you're going to pay it in 5 years and this is your payment and you're going to be done in year 5, or by the end of year 5. For income-driven plans, they see, okay, are you making 50,000, 100,000, 200,000? Well, depending on what the income you have, we are going to tell you how much to pay. So they started with a 20% discretionary income, and they say, okay, so this is going to be a 25-year plan, and we are going to base your payment on a 20% discretionary income. So whatever is after the adjusted gross income minus poverty line, there is a formula that there is for these repayment plans, then that becomes the discretionary income, and that's what's going to tell us how much you're going to pay. So if your discretionary income is 100,000 and we are going to use 20% of that for your payments, well, you have 20,000 a year to pay for your student loans. Now divide 20,000 divided by 12. I'm going to do that. And that is like 1,600, right? So it's a lot. So in 2009, they came with another one, and now that one became a 15% discretionary income. And that became known as of today as the original income-driven plan. I mean, income-based repayment plan, sorry. Because there is a change that happened in 2014, as you see on the screen, where they say, oh, let's make changes for newer loans, right? So any loans that came after July 1st, 2014, then those are going to be based on 10% rather than 15%. So the day and year of when the loan was issued really matters about what repayment plan you might get into, right? So in between, there was in 2012, the pay as you earn, also known as PAYE, P-A-Y-E. That was also 10% discretionary income and is for 20 years. So as you can see here, they both have the same formula, except, well, depending on when it was given to you, there are rules whether you are able to get on that repayment plan. Oh, and by the way, what you see here is that in 2015, there was a revised pay as you earn, and the color is lighter here on your screen because that is the one that is in courts, right? So it's very likely that it's going to go away. In 2023, revised pay as you earn became SAVE. And then SAVE is the one that had a lot of benefits that certain individuals didn't like, and then there has been an issue with it, and it might disappear. So that's why the color is light here, because let's not really worry about that one, because it might just not be there for you. All right, so the benefits of the income-driven plans, as I mentioned, is based on your adjusted gross income. If you ask me, what's adjusted gross income? Well, let me just say there's more to it, but out of your gross income, so let's say you make 100,000 and you are one person that puts 20,000, 20% of your income in your 401k pre-tax, right? So you are pretty much lowering that income or the taxable income for that year. So let's say you do a deferment of 20,000 in that 100,000 gross income. Now it's just going to show as if you had 80,000, right? In income. That's the taxable income. So in reality, you did have more, but taxable income is getting lower. So that's just the premise of it, how you get to adjusted gross income. There is more, of course, more pre-tax deferrals also keeps lowering your adjusted gross income. The monthly payments are based on the income. Remember, it's income based. The income, not the balance, right? So it's not going to divide the 100,000 debt in 10 years, but it's going to see you are making this much, and because your discretionary income is this much, this is how much you can afford paying based on the formula of the repayment plan you're in. The payment changes as income does. So if you are working in a community base and maybe the income is not great yet, then your payment is going to be lower. But if you are doing really well, then your payment will be higher as well. The subsidies for the first 3 years, for subsidized loans and repayments, except ICR. So this is a little bit deeper than what we're going to get into, but there are things that you might want to pay attention into when you get in a repayment plan. The income, the spouse's IDR consideration of head of household, so HH is head of household, overall payment. What does that mean? If you both have incomes and you both have student loans, there is a formula, so you're not paying too much as a household. But if you only one of you has student loans and you both have incomes, well, the household income is pretty high if you're filing jointly, pretty high for one person to make payments. There are rules, and you have to consider that the more income there is in the household, if you're filing jointly, well, then also is going to be your payment, right? Now in California, so in other states, like non-community states, if you're making less, woohoo, you're good, right? Because you can file separately if that's what you decide, and then just use your income. In community states like California, it has to be 50%, right? So if you're making 50 and your spouse is making 100, well, the household is making 150. Your half is 75. That is going to be the adjusted gross income as a married filing separately, individual. The good thing, though, in community states is that if you're making more and your spouse makes less, well, the one that wins, right, is you, because you're going to lower that income if you file separately. So just an idea about what to think about when you have loans and your incomes are different from your spouse. I hope I'm not going too fast. I know there is so much here. Don't worry, we're gonna go see examples and we're gonna talk about this again. All right, so requirements for IDR is that income-driven repayment plan is that you're gonna go to studentaid.gov. That's your hub. So if you have been around with servicers, you know that last year it changed into, so let's say you have Mohela. So now it ends with .gov, because even though you still have a servicer, now they are under the umbrella with the government, making sure that things are going well. So the place to go and see your loans and make changes is studentaid.gov. The loans must qualify for the plan, right? And I'll cover that. Some income-driven repayment plans have a partial financial hardship qualification. I will cover that too. And then the one thing about income-driven repayment plans is that if it's based on your income, well, you need to tell the government every year what your income is. So they give you the amount that you're going to pay in the next 12 months. So you have to submit an income recertification every year. They call it the anniversary. So let's say you apply in April, and then you get in the repayment plan in April. Most likely the next time that you're going to do a recertification will be April 2026, right? Because they want to see your income again a year after. Okay. To choose a plan. So here I'm talking about the IDR. But to choose a plan, really, you need to know what you want to do, right? So if for you paying faster makes more sense, maybe a standard repayment plan will work. Or maybe you want the opportunity to have a lower payment but make higher payments if you wish to do so, right? Depending on what goals you have, what kind of work you're doing. So if you have a large loan and your income is going to be pretty decent, but not high, then you might run numbers to see if, and you're working for the government or for a nonprofit, you might want to run estimates to see if PSLF might be a path for you, right? And I'm going to cover PSLF, which is Public Service Loan Forgiveness. The adjusted gross income matters. The length of the plan, right? 20 or 25 years. And I have 2 stars there because, yes, it's one of those that are in court, and I will go deeper into that. Just keep in mind that before IDR, even months ago, used to be that you reach 20 years or 25 years, whatever the length of the repayment plan is, and the balance left will be forgiven or canceled. I would rather use the word canceled, except that you're going to pay the taxes. If you're not working for the nonprofit, right, or government, then you pay the taxes on that cancellation. Well, there is now issues with that rule or that plan where people might not be able to do that anymore. However, the PSLF path is safe. That is something that I will cover, but just a hint here is that the PSLF is a plan shortcut that was implemented by Congress. And because it went through Congress, it became a law, right? So it's a rule there. So it's harder to kill PSLF. So maybe you are here thinking, I'm going to ask the question about, is PSLF going to survive? Well, I don't know if we will. What we know as a professional in student loan planning is that it's very hard to kill it because it went through Congress. It will have to go through Congress again in order for this to disappear. And we will be ready to be fighting that, right? Tax filing status matters. Again, are you filing with your spouse and your spouse is making too much? Or are you single, or are you filing as married, filing separately and getting divorced? It's like there are different rules. The type of employment, again, nonprofit, government, qualify for PSLF. And if you are working for the private sector, if the repayment plan, so IBR still is able to get on that a 20 or 25-year forgiveness, that's the only one that is okay right now. Then if you reach that point and you still have a balance, whatever gets forgiven has to pay taxes if you're in the private sector. All right. So studentaid.gov, what do they do? They have, first of all, you have to think about what goals you have, and then you're going to run estimates with the simulator. It also, you can simulate it whether you can consolidate or not. Sometimes you will have to consolidate again if you have those older loans, FFEL loans, non-direct, then you will have to consolidate into direct loans in order for you to get on some of those repayment plans. And then you have to do the annual income recertification. Okay, going back to those loans or plans. So again, the oldest one is ICR, income contingent repayment plan, then IBR, income-based repayment plan, then pay as you earn. And then again, changes into the new IBR, and then revised pay as you earn. That became SAVE, came later. If you look at the right, all the way to the right, you will see that there is something that has a PFH. That is the partial financial hardship. What is that? So the way that PFH is estimated is that when you start making payments, so you graduate and you're ready to start making payments, they see your balance. Okay, what's your balance? Here's your principal and here's your interest. This is the total. If I take that total right now, so now you're going to start making payments. That's key when you start making payments. If I take this number and I divide it in 10 years, as if it was a standard repayment plan, what will be your monthly payment? Okay, voila. So this is like 1,600. Okay, that is your payment cap. So again, the number that you get when you start making payments, simulating it as if you were going to pay off your loans in 10 years, what will be the monthly payment? That becomes the number. They call it the cap number, the payment cap. If the loan or the repayment plan, sorry, if the repayment plan has a cap, they also have a partial financial hardship. So let's just use that 1,600. So let's say your payment, your 10-year payment will be 1,600. And then they run the number for pay as you earn, right? And they say, well, pay as you earn is giving me, given the income that you have and the balance and all, is giving me a number that is 1,200. Oh, you are lower than 1,600. Okay, you do have a partial financial hardship because that means that your income is not good enough to make it 1,600 or more. So you do qualify to get into pay as you earn, right? But let's say you have a greater salary. And then when they run the numbers for pay as you earn to see if you qualify, and they say, well, oh, it's 1,700. It's higher than 1,600. You don't have the partial financial hardship. You don't need the income-driven plan. You can pay the 1,600, right? So you will not qualify for the partial financial hardship. And therefore, you're not in a repayment plan that has a cap. And the cap will be the equal of the 10-year repayment plan as of the time when you started making a payment. I know, this is why I get paid, because it gets complex. And trust me, we run numbers and then, sometimes everything looks good. I have my cheat sheet here, and I make sure that the numbers, when it's your first loan, okay, so you don't qualify for pay as you earn, but well, okay, you qualify for IBR, the older IBR. So we do the estimates, and then there is maybe something that I miss, and we need to re-estimate again. So that happens. So again, you can go and play with studentaid.gov. That might give you some information there, and I will show you also what other tools are out there that you can just go and compare. So partial financial hardships. That is very important for you to get into some of those income driven plans, which is IBR, pay as you earn, and the new IBR, right? So the only one that you see here of the existing repayment plans, the income driven repayment plans, is ICR. So ICR is the only one that doesn't have a partial financial hardship. So you can make a lot of money and then you run the numbers and you say, okay, this is better than a standard repayment plan. I'm going to choose ICR because they don't require me to take, to have a partial financial hardship. And it's becoming real, especially when we don't have save and revised pay as you earn. The predecessor of save didn't have the partial financial hardship for you to get on an income driven plan. So you had a ICR before, just a year ago, you had the ICR and you had another loan like revised pay as you earn or save. A year ago was save. That you will be able to choose depending of, the estimates, which income driven repayment plan you might be able to get in. Right now, we are seeing that if you are on an income driven plan called save and you need to go into another income driven plan, depending on how much you make, the only choice might be as an income driven plan, ICR. Okay, so let's see. Why was save so important? But also, why is it that a lot of people didn't like it? Well, savings on a valuable education came to be there for people to get on as a 10% of discretionary income, as we saw here. And if you look at this here, the poverty line, so the poverty line is the number that is protected. So they take a percentage of the poverty line. So the poverty line of one individual in the most of the states is 15,000, right? So, and then there is a chart where you can see like what is the family size and the percentage of poverty line. So as you can see here, the poverty line for SAVE was higher than the others. What this means is that there was more money being protected for you to keep over the others. So for instance, the repayment plan ICR only protects 100% of the poverty line. So again, if you are an individual, it only protected like about $15,000 of what you make, right? Based on your adjusted gross income. And versus SAVE was protecting 2.25 more than that, right? So that was 15 plus 15 plus 25% more, right? So you were protecting 35,000 versus 15,000. So there it goes. That's one of the reasons of why some people didn't like it, because it was really helping people and not enough money for Treasury. Okay, so other things that didn't come into place because it disappeared before this was able to be allowed is that it was based on 5% of discretionary income for undergrad loans. And that was going to be very different from everybody that is at 10%, right? The newest repayment plans were at 10%. So there is higher income exemption, which is, the exemption of 225% of the poverty line, and subsidized unpaid interest. That was the biggest one. That means that, let's say your payment should be under the SAVE plan 1,000, but your income, you're not able to pay because of your income, you're not able to pay the $1,000 in interest, right? I'm sorry. So let's say the payment is 1,000, and out of that the interest is 800. But the payment really that you're making is not covering the whole interest, right? For some reason, that interest was going to be covered by the government. So that is the biggest reason that, because of that big subsidy from the government, well, some didn't like it. Okay, so I'm not going to go more into save because it's not there anyway, but just telling you, sharing why they might not have make it survive. Okay, so PSLF for public service was born in 2007. So you needed 120 payments, which is the equivalent to 10 years, but don't confuse it. It's not the years, but it's the payments that count. So 120 payments while working full-time for a qualified employer. And this was special for the federal, state, local governments, and also for people that work for 501c3s, nonprofit organizations. And because it was born in October 2007, then around October 2017, people, if you did everything right, were reaching the 120 payments that were qualifying it. We also heard those news that everybody said that that was a scam because nobody was qualifying. And the reason that that sounded like a scam is because the people didn't know the rules. And for the few that follow the rules, right, they were getting that forgiveness. So that's why there were so many changes in the last 3 years to make sure that people have the opportunity. If you were not able to get that forgiveness, what things can you do? Oh, that's because you were under the FFEL loans. Oh, you needed to go and consolidate them into the direct loans. Oh, but people didn't consolidate because they were going to lose all their history. So the administration said, well, okay, we're going to let you do this without losing your history. So we saw a lot of changes and a lot of great benefits for student loans in the last 3 years. Unfortunately, that's not the case right now. Now we are fighting that back. But let's see where we get with the student loans. And again, let me just repeat what I said earlier. PSLF will need to go through Congress in order for this to disappear. So don't fall into the trap of being fearful about the future. We will know when it's going to be there, right? Because it will be the talks in Congress, but it will need to go through Congress for PSLF to go away. And let's not confuse PSLF with a repayment plan. PSLF is just a shortcut. PSLF is, I'm going to work with the government for 10 years because even though I am in a path of 25 years or 20 years, I can take the shortcut by just working full-time while making payments under a qualified repayment plan with qualified loans and get there in 10 years rather than 20. So that's what it is. It's a shortcut. Income-driven plans are vehicles, right? So the red could be pay as you earn. The older one could be, older car is an ICR, income contingency plan. And then the green one might be, the IBR plan. So those are just vehicles of how to get to a goal. In PSLF, again, is a road, is a shortcut. This is what you're gonna drive through to be there faster. Okay, so again, PSLF qualifications, 120 payments, missing the S there. While working full-time for a qualified employer, they have to be direct loans and they have to be under a qualified repayment plan. So that's the little picture, the 5 things that you need to fulfill. And send your employment certification. So what is that? So let's stop there. Employment certification is not income recertification. Remember that the income recertification needs to be sent every year? Well, guess what? Employment certification, why not send it every year as well? But the employment certification does a different thing. The employment certification form is informing the Department of Education. It's informing the government that you are working for a qualified employer because they can see your payments, right? They can see that you are under a direct, all direct loans under a good repayment plan, income-driven repayment plan, but they don't know where you work, right? So they receive your income, good, okay, but are you working for a qualified employer? That's what you do. You send an employment verification or certification and tell them, here, I'm working, give me credit so I can reach my 120, so I can do my shortcut. Okay, so any questions so far? Probably not. So let's see. Let's see what's happening with Tom. Let's go back here. Okay, so Tom graduated in May with a master's degree, so he can improve his income, right? His total federal loans are 70,000, 7%. And when I say 7% is an average, right? Because every year it might change. So he might have different interest rates for different loans, but let's just call it 7% average. He just got a job for the city of San Francisco and he's working full time. He's going to get married in 2 years. He wonders if he should even consider PSLF, right? Because I'm working for the government. Should I consider PSLF? Is it worth it? What else can I do? And again, that is important to know. Well, he's planning to get married in 2 years. We also want to ask, are you planning to stay with this path? Like, do you want to work for the government for the long term? Or what is your goal? What's your dream, right? Because that really matters. Because if he's going to be, he really wants to work for the tech industry, right? It might be that the PSLF won't be the path to follow. So we need to talk about, okay, so you will pay the least by doing this, which is not PSLF. But also, here's another piece. And I have seen that with doctors, for instance, that they might just hate debt, right? So doctors, for instance, have a very interesting path because they have residency, sometimes fellowship. Very often it's in the public sector. And then they might decide, well, I did my residency and I did my fellowship, so I can go into the private sector and make more, right? It's valid. And they might say, I just want to pay it off as soon as I can. Right? So, and I have seen, I had a dentist that told me I paid it off in 4 years and it was 300,000. So all of her money was going into debt because she could not bear to have debt, right? So it's important to know what's the perspective of the person, the borrower. Okay, so let's see. Here I'm gonna try to show PSLF and also the payment cap. So if we see, let's go here before. If we see here, the income that he had last year in 2024 was 95,000. He's still single, one person. You see number of family, one. And by the way, he's putting 5% of his monies of his income to retirement pre-tax 401k, 403b, right? But then he has changed, right? So his income now in 2025, and forgive those numbers, and I will show you why that year is different from what I'm talking about. So if he has to show his income today, if he's applying for an income-driven plan, he's going to show his previous tax return, right? He's going to be showing his 2024 tax. That's why 95,000 in 2025 is showing on the screen. Now in 2026, he will have filed his 2025 income. So that's why in 2026 is showing the 2025 income of 115,000 minus the 5% of contributions. So here's the adjusted gross income, right? So that's, you see the difference here. The retirement contribution pre-tax will lower that adjusted gross income. So in those first years, this is the payments under an income-based repayment plan. It will be 562, and then with 115, it goes to 716, right? Now, the reason I'm showing this 10-year payment, because remember that the partial financial hardship, right? The partial financial hardship means that when he started making, he got into this income-driven plan and started making payments, when they divided the 80,000 in a 10-year plan, his payment will have been 929. So they say, okay, so this is going to be the number that we're going to use, the anchor number to see if it's lower, then that means that you qualify for IBR. In this case, he did qualify for IBR, right? What would have happened if he was married already and they had both incomes and they're making 300,000? So if they're making 300,000, oh, will be less actually. Here, even 150,000. Well, this is one person, but let's pretend it's 150,000 for two people. If his payment, when you do the calculation, is 929, which is equal or more, and the reason this stays, I will tell you why, is 929, right? The same as the 10-year, you do not qualify to get on that because they say, okay, you are making enough money to pay more than 929. Sorry, you don't qualify for IBR because you don't have the partial financial hardship. Okay, so on the other hand, if he was making 95,000 last year, he did qualify to get on IBR in 2025. Okay, so in next year, he sends his income, his payment will still be lower than 929. And then his income changes, right? The year after, great. Congrats. Look at what happens to the payment. Guess what happens here? Why is this not going higher? Because remember that he has a partial financial hardship. Remember that those that have partial financial hardships also have a payment cap, which is equivalent to the 10-year plan. Well, Tom just hit it. So he now makes payments of 929, and as long as he continues sending his income recertification every year, he can make a lot more. Like he gets married the year, in 2027. So in 2028, he's showing that his income and her income. So let's pretend that he makes now 150 plus her 150. That's 300,000. So, but his payment didn't go up because it's already at the cap, right? So that is the beauty and also the problem with these repayment plans, that they do have a partial financial hardship to get in. But on the other hand, if you make more than what is the equivalent of the 10-year payment, then you still fine because that is your cap, like it happened with Tom. Okay, so let's see. So we will see that he can pursue PSLF. He says, yeah, I'm going to stay with PSLF. What will happen with me? So if he pursues PSLF, then he might be paying between 562 to 929, right? And then end up paying 98,000. And I didn't put it here, but then there is a balance left of about 17,000, and that's what gets forgiven, and he doesn't have to pay taxes, right? Or he can say, I hate debt. What can I do? Well, if you want to pay faster, how much can you afford, right? Can you afford this much? If you want to pay equivalent to what you would have paid on the 10-year PSLF path, well, you would have to make payments of 1,364, and you're done in 6 years. How does that look, right? You want to do something equivalent, but faster. Or you might get lucky, not right now because the interest rates are not good. But if in the future you say, well, what happens if you refinance? Well, if you refinance your 80,000, if you go on a 10-year again, the difference is not huge for 3,000 more, right? You're going to pay a money, 849, that is just the same number for 10 years, and you're going to be done. And this is how much you're going to end up paying. Or if you can afford $1,000 every month, you pay less than if you pursue PSLF, and then you're done in 8 years. Or if you will have the money, so that's all you do, paying your loans, then you might save money for, in the long term. But what do you want to do? So let's say he says, okay, so I got this job, but my dream is going to work for this tech company, and I will have a decent income to pay this faster. So there are choices there. Okay, so I see a question. So for those of us who in the SAVE program that works for a nonprofit, can we make our 100 payments at any time and we qualify? No, because you do have to go through your 120 months working full-time work. But I will cover the buyback if you get to the time 120 months, but you're still missing the payments. And that is a program that you might benefit from. But unfortunately, no, you cannot make prepayments if that is your question. Okay, so if you're pursuing PSLF, go to studentaid.gov, your hub.
Sorry, Rosario, I think there
Yes.
was one other just clarifying question from when you were talking about the qualifications. Someone is asking, when should you send the employment verification?
There is no hard rule on when. So for instance, there are people that come in and they have never sent their employment certification because they didn't know that they had to, right? That they had to inform the government where they worked. Send all of them for the previous employers after that you have worked with after October 1st, 2007, and see how many, payments and months working with them are matched. So you know how far you are from PSLF. As a rule, for yourself, I will send them the same every year, the same time as I send my my income certification. So that way I am counting 12 more every year. And it's easier to take an account. Yeah.
Okay, thank you. And then I noticed someone has raised their hand. Could I ask, please enter your question in the Q&A window, and that way we'll be able to address that. Thank you.
Yeah, thank you. Alrighty, so pursuing PSLF, again, goes to studentaid.gov, go to the PSLF help tool. That helps you to send the employment certification. Okay, so that's to answer that question. What else can you do to send your employment certification? It used to be by paper that you had to print the paper, fill it in, get wet signature, and send it. Now you can do it through DocuSign. Remember to have your employment identification number, which you can find on your W-2, and also the email of the person that is going to sign that document, testifying that you did work for this many months full-time with them. And try to do it every year. It's best, so that way you know how far you are. Okay, tax filing status. So where do you live? Do you live in California? Remember, whatever is coming in the household, 50 and 50, if you are filing jointly, it's all of it. If you're filing separately, it's going to be half of the household income. So IDR allows for married filing separately. Um, I'm going to mention this, but I'm not going to go deep into this. But just a week ago, there was, like 10 days ago, there was an issue that day, one of those days, I called a servicer for to help a client, and I was informed that the IBR plan was going to consider, even though we had filed separately for this couple, they were going to consider both incomes. So yeah, we just got a letter saying that this is what we need to do now. That was nailed it. And a couple days after, then everybody was talking about it, saying, well, yeah, it was a mistake. No, it wasn't. And then they went back and they said, okay, yeah, Circuit 8 is not considering that both incomes. It is still, yeah, going to be one person, like the income of the one person, whatever it is on your taxes. So just in case you heard about it, it's you. It's only one income, not both, okay? Consult your tax professional. Why? Well, because trying to do married filing separately in California. I do taxes. It's painful. It is painful because we have to make sure that it's 50-50, and still sometimes California itself, the tax board gets gets back to you and say, hey, this is wrong. This says that you withheld this and it wasn't that much. You withheld less, right? And then you have to explain again that this is because of the 50-50 of married filing separately. So speak with a professional, and of course you're going to pay two taxes when you're filing separately. Compare the savings on student loans versus how much you will be paying as a household by filing separately. So it's just a way to know whether you're actually saving. Okay, so and sometimes you might not benefit in a community property state, but likely you will. And I know we don't have much time. Wow, it's almost an hour, but um, we have a lot more to cover. Okay, so this is very important. The partial financial hardship. So have we heard lately what's happening? That they are trying to say that, well, some of these repayment plans shouldn't be there. In fact, pay as you earn in ICR, and I have it in light colors here. And the reason I did that is because those were going to disappear in the fall last year. And then they came back in December because of the save issue, right? So they say, okay, well, if we don't have save, well, then let's bring back this. So they were able to, bring back the ICR and the pay as you earn. So that is still there. So we just have to watch it. Those two did not go through Congress. And that's why a lot of people talk about, oh, those might disappear, right? So the safest one is IBR because that one did go through Congress to be there for you. So that's going to be the hardest one to eliminate. That doesn't mean that pay as you earn in ICR will go away. It's just keep it in mind. And again, the partial financial hardship. Some people that are making too much to move from SAVE into another income-driven plan is going to be a challenge. Okay, so Amy and Jake. So Amy's income is 90,000, 2024. Highly qualified algebra teacher for the county of San Francisco. Jake is making 50,000 as of 2024. He's an entrepreneur. His income will likely double in 2 years, right? They both live in and work in California. Amy has 45,000 in federal loans at 7%. Graduated in May 2023. Her loans are still under a standard repayment plan, so she hasn't made the move because of all the forbearances and all that. She hasn't made the move into an income-driven plan. Or it could be that when she tried, the income-driven system was closed, very likely. So she's still on the standard repayment plan. Jake has no loans. They are getting on an income-driven plan that might, but again, depending on how much she's making or they're making, she might not be able to get on that plan because of the partial financial hardship. And there it is. So making 140,000, right? They put some money in that retirement contribution, so the adjusted gross income is 133. Family of two. Look at that. The payment in yellow is equal to the 10-year payment. And the reason it's showing equal is because of the payment cap, right? So it doesn't go higher, but at the same time, if it's equal as the 10-year payment, that means you don't qualify because you're making too much. You're making the same or more than the equivalent of the 10-year standard payment. So she won't be able to get on IBR. However, let's say they make the same amount in 2025. So in 2025, they make the same amount and they say, okay, what can we do next year if I really want to get into IBR? What about if we file separately? Well, let's say they make 140 divided in two, 70,000, right? The adjusted gross income is 66.5 for Amy. Now look at that in yellow, it's showing 275. and it's lower than the 10-year payment, which is the payment cap, right? She has a partial financial hardship. She can qualify for IBR. So these are the things that it's good to talk with a professional or run numbers on the simulators online on the studentaid.gov. Okay, so and again, let's say in the next year, this is filing separately again and still making it at that point. But then at some point, he's going to be making more, right? So Jake is going to have a higher income. At some point, they're going to reach the 522, and it's fine because once you are in the plan, you can stay as long as you keep sending your income recertifications. But remember that she is a teacher. She's a highly qualified algebra teacher working for the government, right? So we can consider, well, is there any other plans that you can pursue other than PSLF? By the way, you cannot use the same time that you're pursuing PSLF with some of the plans that teachers might have, right? So it's one or the other and what makes more sense. Okay, so in this case, we're going to consider the alternative, right? Teacher loan forgiveness, 5,000, or because she is a highly qualified algebra teacher, math or science, she can get the 17,500 after 5 years of service. Okay, so if she gets 17,500 in 5 years, after 5 years, her new balance, after making the payments, right? She's making her payments, she will have a balance of 20,591. Then she might consider just finishing in 3 years or just actually refinance and lower the payments if she needs to, right? And be done in 5. Like, what other things can you do for your loans where you are still able to have a livable income, right? You still have enough cash flow and be able to pay your loans in an equal manner as a PSLF, right? Or just pursuing maybe the long term. Okay. There are 2 questions. I was not able to qualify to get signed up for the SAVE program because I only work half time at school district and her half time. Okay, so if you were not able to qualify for SAVE, that's good because, but what about other loans? So if you were working only part time, it is fine. So the income to get on a plan, on an income driven plan, your income has to do with it. Now for PSLF, it's different, right? Let's see, they have time in a school. That means that you're not pursuing PSLF. Like you're not getting credit for PSLF. You're still able to get on an income-driven plan, but you won't be able to get credit for PSLF if you don't have 30 hours or more on average per week for a qualified employer. Yeah, so when it comes, you just have to run estimates to see what will work best for you on what kind of repayment you should pursue. And then the next questions by Nina, I will be a special education K-12 teacher in San Francisco. I think that's okay. When I graduate from San Francisco in 2027, my income currently is 28 and my total debt from Berkeley undergrad 45. I didn't qualify for loan forgiveness nor SAFE plan when I asked about 7 months. How can I learn about IDR after I graduate? And I will be working for the government. Yep. So it depends. If you've been working before, if you worked for the government before and you were working full time, that might count. So you might want to consider, okay, how much time did I have already under my belt? And now I have new loans. Does it make sense to consolidate or not? Like what are the rules on consolidation by when I graduate? So make sure that you read the updated rules when you graduate. And if you're going to follow the government or nonprofit, that's a great way to get your loans. Still run those numbers. If you don't have any time with qualified employers before, and you are sure that you're going to follow PSLF, you might not need to consolidate because you're going to start from zero on both groups of loans. So let's say you had undergrad and the grad, right? So you're going to just start running the numbers for PSLF for 10 years. So just see what the rules are when you graduate, because it's possible that you don't have to consolidate and you still will be able to get on an income-driven plan. Whatever is the oldest loan is going to tell what kind of repayment plan you will be able to get in. Plus, you have to have the partial financial hardship. Okay, so refinancing into private loans. So pros and cons. Let me see. One more question. If you have mentioned a few times something about save, that is not good if you didn't get on to save. Can you explain what you mean? I may have missed something about what is currently happening with it. Yeah, so save is under forbearance since July 2024. And if you're pursuing PSLF, mainly, if you're pursuing PSLF, that time has not been counting for PSLF. Now, if you're pursuing, I see an income-driven plan, the long path, at some point when SAVE actually, they are in court, right? The reason that they are on forbearance is because it's still in court trying to see if that is a viable plan. It's likely that it just disappears, something that they might just get changes, but it's very likely that will just go away. But for now, all the people that are on SAVE are sitting there waiting to see what's going to happen with the loans, right? Some people like that they are on SAVE because they are not making the payments because they are on forbearance and there is no interest accumulating. However, I think that the people that are getting hurt the most are people that are pursuing PSLF because the time that they're working with qualified employers is not being counted. Now, there is a way to get to it, to get that time back that I will explain in a few slides. Let's keep moving so that way we can cover that. Okay, private loans. Some people say, I'm going to go private loans. It's cheaper. Be careful. It's right now, their interests are really not competitive. So it's likely that the government will still be better for you. Remember that the government, you can ask for forbearance, deferment, you go back to school, it stops your payments if you cannot make those payments. So there's more flexibility with the federal loans. And with the private loans, well, that, they're making money. The business is to make money. So you have to make those payments. And there is always, it's like having a car. There is a timeline of when you should be paying those loans off. So just take a look at that. But sometimes refinancing into a private loan might make sense. So it depends on of what you're looking for, what goals you have. Okay, so to answer the question about SAVE and about all the repayment plans that you might need time. So let's say you have worked for the employer for that 120 months, those 120 months. However, there were some periods, and I will go here, there are some periods in yellow here where you ask for forgiveness, hardship, something happened in the family for whatever reason, you got some time in forbearance or deferment, except school. School doesn't count because that was a choice, right? But if there was something that happened or something that you didn't want to happen, like the SAVE forbearance right now, where you're missing the payments, because honestly, even if you make payments with SAVE right now, it doesn't count. It won't count for PSLF. So what I tell people, if you are on SAVE, save that money. Because let's say that you don't have many months, as we will see soon with Dr. Sally case, is that if you are not far from getting to that PSLF timeline, so let's say you do have now the time, but you were missing those payments, you can request a buyback. And I will show that to you. So buyback. So this is designed for borrowers that already have reached the 120 payments. Sorry, months with the employer, but they are missing some payments because of something that happened in forbearance or deferment in the past. They have to request it. It's not something automatic. There is all the sets, even the language that is being offered by studentaid.gov about how you request that. And there are rules, right? They have to be direct loans. They have to be under disciplinary repayment plan. And you have to continue if you're not on safe, because obviously on safe it's on forbearance. But if you are under another kind of repayment plan, you have to continue making the payments while you are requesting that, and then it's going to get reimbursed to you. So exceptions, if you have deferment or forbearance that you want to buy from the past, except in school, in grace period, defaulted, or in bankruptcy, you can request to get those months to be counted by paying for those months. So that's why you need to save your money. If it gets approved, they give you 90 days to pay all of it. There is no like, oh yeah, let me pay that during the year. No, you have to have the monies to pay those months that you're requesting. And then, so once it gets approved, you pay those, then you get your forbearance, forgiveness, sorry. Similar words, not really. Okay, so you're missing some months, you're gonna buy them back. And this is Sally. Okay, Sally is a physician. She makes, well, actually, she has 150 balance in federal loans still. She has worked for 501c3s over 10 years. As of July 2024, she had 114 PSLF qualified payments. And I said, as of July 2024, sorry, because that's when safe people went into forbearance. So she said, okay, so I was almost there, and then I was thrown into forbearance, and now you're telling me those don't count. Those months since July, August don't count. So Dr. Sally has fulfilled some of the requirements, right, for PSLF. Her loans are direct under an income-driven plan, SAVE. She has worked full time for 120 more months for qualified employers, and she's missing those 6 months. And if we count, yeah, so from August to April, there's more than 6 months. What can she do? Well, the buyback program. So the buyback program is a request. So you send this, first you have to send the employment certification saying, hey, I have worked for qualified employers since all this time, and now I have over 120 months. But you are making me miss my target because you put me on forbearance. Can you please help? So you request, okay, so I'm missing August, September, October. So you name those months, and they do the calculation, and they tell you, okay, so if it gets approved, you were supposed to be making payments of 1,000. So pay me the 6 months, and then we will go from that. Do you have that will you have that in 90 days? You should, because otherwise you won't get that buyback request approved. Okay, so that is safe, but if you are there, you see on the right, bottom right, is that if you're on an income-driven plan where you are required to be making payments, you have to continue making payments. That's one of the rules of the buyback. Continue making payments, and then anything over the 120 that you were required to pay will be reimbursed. Almost there, almost there. Okay, so what's going on with the federal loans? SAFE, as I have been saying throughout the presentation, is likely to be gone soon, and borrowers might need a new plan. The one problem I see is that people that have higher income, who knows if they're going to have the partial financial hardship, and they might just end up going to the oldest repayment plan that has a weird formula. So it doesn't necessarily mean that you're going to have a horrible payment, because there are two formulas for that ICR repayment plan. But that might be the only income-driven repayment plan that might be there for you. Plan higher payments after income recertification. Why? Because I don't have the number, but most people that have been on an income-driven plan pre-COVID, they have not sent their income recertification. It has not been required from them. And guess what? As of right now, like just like about a month ago, they said all of the income-driven plans don't have to recertify until February 2026. So again, all the people that haven't recertified the income during COVID, and I have seen that with doctors where they had no income because they started making they got into an income-driven plan and they had the taxes for the year before they started working. So zero income, zero payment, or their last income recertification was while they were resident, right? In residency. So if they were in residency, they were not making the same amount as if they were full physicians, right? Like in attending. So the payment might be very low, and then when they recertify, the payment will be really high, assuming that that they are in a repayment plan that will survive. That's something that is not safe. We will see what will happen with safe. So safe forbearance might end in the fall of 2025. They say it might be pushed, or the temperamental administration might be like, no, let's do it sooner. So just be ready. The current forbearance period doesn't count for IDR or PSLF. Answering the question that was there for somebody that unfortunately that PSLF people get hurt the most. IDR recertifications are not until after February 1st, 2026. This is important. The 20 and 25-year forgiveness, this is one of the newest, is that 20 and 25-year forgiveness under SAFE, PAY, and ICR are being questioned by the 8th Circuit Court of Appeals. That they say it's illegal to get forgiveness after that 20 or 25-year path. So people are having to pay longer from what they have been told all this time. So people that did reach that in the last year, they were fine. They got the forgiveness, they paid their taxes, but now we don't know what's going to happen in the future. Sit tight. Don't worry about things that we don't know. We don't know the fate about. So, but just get informed. This is what's going on. A collection on defaulted loans that used to happen before. After COVID, they said, well, people are in distress, people have no jobs, so they stopped the collection of defaulted loans. Defaulted loans is considered if they haven't received payments for 217 days. So that's going to restart in May because they want their money. For if you are in default, you can consolidate your loans or you can get into rehab. So the rehab is also 9 months, and you just have to call your servicer and set that rehabilitation program for you. And then you have to make those timely payments for 9 months, and then they will put you into the full timely borrower paying on time. Studentaid.gov is a tracking. It has a tracking system. What does that mean? PSLF people will know that. It's showing how far you are from PSLF. It's showing how many payments you have had under your loans. And I think that's one of the coolest things that happened. That was one of the last pushes from the last the former administration, is that now we are able to see, hopefully it stays, that we are able to see how far we are from our path, right? And again, let me just repeat this. PSLF and IBR, they are statutory. That means they went through Congress. They are not easy to kick out or disappear. So especially if you are under the IBR program, and if you're pursuing PSLF, don't worry. I mean, what can we do? And now, if you get a letter saying, hey, support this, go and support, because when you're supporting you're supporting also your colleague, you're supporting your children, you're supporting a lot of people that need this help. PSLF program. But as of right now, those, if you're on IBR and you're PSLF, that you are in one of the safest places. And where can you go to do some simulations? Student.gov has one. CSLA, which is the student certified student loan administration. Wow, I should know that. I don't know what the A stands for. Right capital student loan modules. If you have a financial planner, they might have some software that will have those simulators. I really like the VIN Foundation tool, which is the vets, like veterinarians um, site, and they have really cool software to run numbers. And Loan Buddy, if you're gonna go pay for uh, somebody to help you with it. Okay, in summary, we covered what type of federal loans there are, from the oldest ones, FFEL loans, Perkins for people with lower income, and the newest ones, the direct loans. The type of loans, they can be standard, they could be extended, or they could be income-driven plans. That's mainly what we covered today. PSLF is a path, is not a repayment plan. It's just a shortcut. The IDR account adjustment, if anybody heard about it, they just adjusted some payments that were the months in forbearance and month in deferments. That's over. That's not there anymore. So if you got extra points there for months that you were under deferment or forbearance, good for you. That was one of the gifts that we got from the former administration. Strategies. So we covered the strategies. I think about Mary filing separately, if you might. Think about when you are going to send your income recertification. If it's at the beginning of the year, right? Am I going to defer my taxes? Like file an extension, these things that you can cover with your tax professional to see whether there is anything that you can do to help with your student loans. And the updates that I just covered, that we will see more changes. We just have to keep our eyes open. Learn more. This is some sites. If you're gonna also get a copy of this, where you can go and get more information for your loans. Already, I see two more questions, and it says, anonymous. Could people write the Eighth Circuit or the Missouri Attorney General help with groups like Student Loan Justice? Yes, there is like the teacher groups, there are, preparers. I mean, there's all kinds of groups, and yes, definitely you can write, and your representatives, because sometimes your representatives are the ones that are the most unlinked because they don't know what is pressing, right? So when the constituents tell them this is pressing, they will start paying attention more and more. So start with your representatives, but also see what organizations that you are linked to are doing, so you can support that. I try student loan tutor over, I don't know, Buy Savvy, which seem scam like. Have you heard of them too? Nope, I have not. Sorry. What can I say? If I will start with the nonprofits. I used to work at Meta, Mission Economic Development Agency in the Mission in San Francisco, and I did student loan planning there. So check out to see if they are doing that right now. If not, they might know what other organizations. So start with nonprofits. Check out the sites that I mentioned, right? What they are saying, and also the tools that I don't know where it went. That's it. The tools that you can use also to run some numbers. And there are plenty. These people here have podcasts, or they have blogs that you can follow and see what's going on with the student loans world. But also you can go to studentaid.gov, go all the way to the bottom, see notifications, and you can sign up for notifications They are not as reliable as other people might just go and do their blogs faster than that, but you can get the big, the big information from there. Okay, Savvy even. Yeah, yeah, I don't know Savvy. So just be careful with them. Again, I will start with the local nonprofits and go to sites that might give you good information and they are reliable.
All right. Thank you so much, Rosario. You packed so much information into this presentation, and it's very helpful, especially in this moment of uncertainty. So I really appreciate the information you provided to our patrons today. And yeah, I imagine people are going to come away from this just with some armed with the right information and knowing where things stand today. So yeah, thank you so much. We really
You
appreciate
are
that.
welcome. And more than anything, I just want to say you're going to hear a lot of things, and there is bad news make news, right? So just be careful with what you hear, go to reliable sources. And again, PSLF and IBR are the safest. And if you're unsafe and you're able to qualify for another repayment plan, good for you, because that partial financial hardship, that's my biggest concern when you have to get out of the safe plan.
All right. Well, we're out of time today. Thank you everyone for attending. Keep an eye out. Later today, I'll send an email that will have a link to a recording of the presentation, a copy of the slideshow, and a very brief evaluation survey. So yeah, please take a moment to fill that out. And Rosario, thanks again. We'd love to
Thank
have you
you.
back soon because, as you mentioned, things are changing a lot. There will be updates, so hope to have you back soon.
Thank you, Jennifer. Thank you, everybody.
All right, everyone, have a great rest of your day and enjoy your weekend.
Likewise.
Bye-bye.